A company's ESG disclosure is a key source of information that allows investors to assess how environmental, social, and governance factors are managed and how these factors may affect long-term financial performance. ESG disclosures are typically presented through annual reports, sustainability reports, integrated reports, regulatory filings, company websites, and responses to ESG questionnaires. Investors use these disclosures to evaluate risks, opportunities, management quality, strategic priorities, and corporate accountability. Effective interpretation requires understanding both the content of the disclosure and its relevance to financially material ESG issues. The objective is not simply to collect information, but to determine how ESG factors may influence future business performance and investment outcomes. When interpreting ESG disclosures, investors first focus on materiality. Not every ESG issue is equally important for every company or industry. Analysts evaluate whether disclosed topics are relevant to the company's business model, operating environment, and sector-specific risks. For example, water management may be highly material for agricultural or beverage companies, while cybersecurity and data privacy may be more significant for technology firms. Effective disclosures explain why particular ESG issues are important and how they relate to strategy and operations. Investors generally place greater emphasis on disclosures that address financially material risks and opportunities, rather than broad sustainability statements with limited operational relevance. Environmental disclosures typically provide information regarding climate change, greenhouse gas emissions, energy use, water management, waste generation, pollution control, biodiversity impacts, and environmental targets. Investors assess whether companies disclose measurable performance indicators, reduction targets, implementation plans, and progress against objectives. Strong disclosures often include quantitative metrics, historical trends, scenario analysis, and discussions of environmental risks and opportunities. Investors seek evidence that environmental issues are integrated into strategic planning and operational decision-making. Weak disclosures may rely on general commitments without supporting data, making it difficult to assess performance or determine whether management is effectively addressing environmental challenges. Social disclosures focus on issues such as workforce management, employee health and safety, diversity and inclusion, labor relations, supply chain practices, customer welfare, data privacy, and community engagement. Investors evaluate whether companies provide meaningful information about human capital management and stakeholder relationships. Important indicators may include employee turnover, workplace injury rates, training programs, workforce diversity statistics, customer satisfaction measures, and supply chain oversight practices. Strong social disclosures demonstrate how management addresses social risks and opportunities while supporting long-term business objectives. Because many social factors are intangible, investors often combine quantitative metrics with qualitative assessments to understand overall organizational performance and resilience. Governance disclosures are particularly important because governance structures influence decision-making, accountability, risk management, and ethical conduct. Investors examine board composition, independence, diversity, executive remuneration, shareholder rights, audit processes, internal controls, and business ethics policies. Effective governance disclosures explain how boards oversee strategy, ESG risks, and corporate performance. Investors also assess whether executive incentives align with long-term value creation and whether governance structures support accountability. Transparent governance reporting often provides insights into management quality and organizational culture. Weak governance disclosures may signal potential concerns regarding oversight, conflicts of interest, transparency, or strategic execution. Interpreting ESG disclosures ultimately requires investors to evaluate both the quality and credibility of reported information. Analysts compare disclosures against industry peers, third-party research, ESG ratings, stakeholder feedback, regulatory requirements, and historical performance. They assess whether disclosures are balanced, specific, measurable, and consistent over time. Investors also consider whether reported ESG performance is supported by actions, policies, governance structures, and measurable outcomes. Effective ESG disclosures help investors identify risks, opportunities, and management capabilities that may not be fully reflected in traditional financial statements. By integrating ESG disclosure analysis with financial analysis, investors gain a more comprehensive understanding of corporate performance, sustainability, and long-term value creation potential.